You're welcome to the Business Lens on Rapid TV Abuja. And in the world of business, let's look at some of the hot business trends, starting from the Nigeria's Export Processing Zones Authority has urged the federal government to grant businesses and special economic zones a 10-year exemption from the new 2026 tax laws. Also, diesel prices climbed sharply in October 2025, rising a 9.45% month-on-month to 1,398.57 naira per litre, which went up from 1,277.81 naira in September. Next, the Center for the Promotion of Private Enterprise has warned that the delayed submission of the 2026 to 2028 MTEF violates the Fiscal Responsibility Act ahead of the new fiscal year. The next story is Nigeria's decades-old referee system for opening current accounts comes under renewed scrutiny as stakeholders insist that eliminating the referee role would reduce friction, improve financial inclusion, and align Nigeria with global markets. And in the markets, the Nigerian equities sustained its December rebound, today being December 8, adding 412.5 billion naira in fresh market value as renewed bargain hunting pushes the all-share index up by 0.44% to close at 147,689.52 points. We will look at these stories and more. Stay with us. I am Divine Alex, and joining me today is Global Financial Analyst Daniel Efa. You're welcome to the show.
Thank you for having me. Good morning.
Good morning. Okay, let's start with the first one. Nigeria's Export Processing Zones Authority, NEPZA, is urging the federal government to grant businesses in special economic zones a 10-year exemption from the new 2026 tax laws, warning that the uncertainty around the reforms is already weakening investor confidence. Nigeria currently operates 63 free trade zones with over 700 enterprises. And this organization says foreign and local investors are becoming hesitant as they reassess long-term commitments under the new tax framework. The authority also noted that these are crucial to Nigeria's industrial and export strategy, but their revenue impact can only be maximized under competitive and predictable incentive, with companies now planning their 2026 fiscal outlook. NEPZA says clarity on the 4 newly signed tax acts, that's the NTA, the NTAA, NRSA, and JRBA, is critical to sustaining FDI inflows and protecting jobs. The government insists that reforms will widen the tax base and strengthen administration, but operators fear the changes may erode the cost advantages that attract global manufacturers. So that brings me to you, Daniel. With over 700 enterprises operating in SEZs, right? How would removing or delaying incentives for 10 years impact Nigeria's competitiveness compared to other African trade hubs?
Okay, so I think that first things first, in comparison, where we are economic-wise and what we're trying to do with these special economic zones are different from what other African countries are doing. However, the concept remains the same. That what we're trying to do is to improve trans-border trade, improve whatever we're doing with the free trade continental free trade agreement, also to give incentives for businesses to come on board and set up shop in Nigeria. However, you also, because they are free economic zones, they already have extra benefits for being in the economic zones already. Now going as far as saying they should have tax exemption for 10 years, then we might begin to, that will be a very serious consideration from the government because of the fact that that's over 700 businesses that will definitely increase in coming years. Should there be incentive for them? I think there should be some sort of incentive added to what they already have, because they already have a lot of incentives. There's a lot of tax laws that doesn't apply to them, right? But 10 years might be a long time, 5 years might be a good one, but 10 years might be too long. Yes, we know we want to get a lot of businesses to come to the economic zone. Yes. The free economic zone, but we also need to look at the revenue of the government, because yes, those businesses will play in terms of in terms of the end products or whatever they are producing, in terms of how cheap it will be, inflation-wise, good for us. We can attract them with so many, because before this we do tax laws, we already attracted a lot of people to those economic zones.
Okay, do the new tax acts like the NTA, NCAA, the NRSA, JLBA risk shrinking FDI inflows?
However, in terms of FDIs, remember that FDIs in itself is a function of so many factors. Yeah, even though, no matter how your government is willing to accept FDIs, there are still conversations around infrastructure, there's conversations around bureaucracy, there's conversations around ease of doing business, right? So those factors are still there, and that is why I tell people that
Nigeria should look into building to avoid.
so we already have buffers, because that is why we are attracting a whole lot. Because since this was created in maybe like 3, 4, 5 years ago, I think it was this conversation around free economics started in 2019, 2018, the last vice president. And between now and then, we've done a whole lot. Dangote finally is in one of those zones, right? So the concept of the free economic zones has really worked, and it's still working, right? So that alone is a buffer in terms of the how companies are assessing it. Now we're having solar plants coming up, and they're also taking advantage of that same free economic zone. So in itself, it's a good one. Every other factor that would drive FDI is what we need to fix, not necessarily about the economic zones.
Let's talk about balance, right? Yeah. How can the government balance its push for revenue expansion with the need to maintain stable incentives?
Is a trade-off, right? Because then we do want. Personally, I believe that there is a serious lag between government making so much money and that money going back into the economy in terms of creating value, economic value for the people, right? So instead, sometimes the government should take a bit out of that, right, and use it in investing in businesses, and this is one of such, right? So trade off whatever taxes you want to make and get holistically from these businesses, and instead give them incentives that can make them properly function, that can make them improve their production, improve their capacity, that will end of the day increase supply and make goods cheap for Nigerians. So it's a trade-off that the government should be willing to take, and it should definitely.
Compared to other African trade hubs like Kenya, Rwanda, and Morocco, where do you think we are in this?
So as I said, we have peculiar issues. Kenya, for example, his biggest hub is tech, right? Morocco, for example, is industries, right? So we are not yet there yet, because remember that those countries, it is easier to set up. As long as you have your money, you have your business, you likely set up faster than in Kenya and Morocco than you would in Nigeria. And it is not because of the free economic zones, it is because of government policy, infrastructure. So that's why I said that there are other factors that contribute to the drive for FDI. Whether you have an economic zone or not, people will drive FDI if they are seeing the value in your country, basically.
Okay. And while investors in special economic zones push for tax clarity to stabilize long-term planning, businesses across the country are already grappling with another pressure point: surging diesel prices that threaten operating costs nationwide. This is taking us to story 2, where diesel prices climbed sharply in October 2025, rising at 9.45% month-on-month to 1,398.57 naira per litre, up from 1,277.81 naira per litre in September. Now, Enugu posted the highest price at 1,468.29 naira, followed by Niger, which posted 1,465.69 naira, and Jigawa at 1,437.40 naira, while Katsina posted at 1,301.24 naira, and Edo State posted 1,307.84 naira, recorded I think Edo recorded the cheapest diesel. So national consumption averaged 17.13 million liters daily, underscoring the inflationary pressure on transports, manufacturing, and power-dependent SMEs. Now, the question, right, is with diesel up nearly all of these things, where do you think we are going to be?
So I think the rising price of diesel, because people need to understand the fact that diesel is pivotal to logistics, pivotal to industries, and it's almost directly related to whatever inflationary pressures would come on our CPI basket. And with these rising prices, which I don't think it has to do with oil prices, because oil prices has been declining for the longest. I think imagine that we've averaged 63 to 60 $60 per barrel for almost 6 or 7 weeks. So it is not that. It is more about maybe supply issues, maybe supply bottlenecks. Edo, for example, is lowest because there is a refinery there. I think the refinery basically is probably supplying. So what I think should happen is that the regulators should begin to question what is happening, so that we're going into the end of the year where inflationary pressure normally rises because of excess demand. So it's important that we manage the energy, which usually plays. Again, we've consistently have had lower inflation for almost 5 months, and we don't want to erode that gains with energy prices affecting other components of the CPI basket.
Now, how quickly do you think
December.
this is going to translate into higher consumer prices?
It's almost instantly, because then majority of the trucks that move goods across the country are diesel powered. Most of the industries, most of the companies manufacturing, whether it is fast consumer moving goods, they all use diesel as one of their sources of power. So for diesel, it is usually quick in terms of how it reflects on pricing, right, of goods and services, rather than even petrol. Most people think petrol is majorly for transportation. But logistics, which is a very, very pivotal part of trade, it's basically diesel. And I hope this is evaluated on time. Yes, it is not a regulated market, but yet we have regulators to really check to see what's really happening and why are the prices fluctuating like that. Why are they rising when global prices are not necessarily rising?
Okay, now let's look at regional diesel gaps, right? That is as wide as 167 naira. Regulatory inefficiencies are driving, so what structural regulatory inefficiencies are driving these disparities?
So first things first, Nigeria already has a very imbalanced infrastructure in terms of road infrastructure. So that is why you would see diesel prices would be expensive in down south, and be cheap in down south and very expensive up north because of transportation bottlenecks. However, from the figures you highlighted, I think we are also seeing source of the product, right? So for example, I cited earlier about Edo State. There is a refinery in Edo State, so it is only normal diesel prices would be cheaper, right, rather than Jigawa State, which you have to move the product there. So I think that price discrepancy has to do majorly with the supply issues. Remember that diesel has always been regulated years back, even before petrol. So there's already a system in place that you get that the retailers or every stakeholder in that sector already understands. So what the regulatory bodies should just be doing is to just check why the prices are rising and what is the cost. Is it that there is higher demand for the product than the available supply, or there is a supply disruption somewhere from the major refineries that supply or whatever sources of supply that comes in.
Okay, now with average daily diesel consumption at 17.13 million, right, liters, what is the realistic pathway to reducing Nigeria's diesel dependence in transports and industrial power?
I think that first things first, I don't know why we want to reduce, right? but if we must, in terms of fossil fuel dependency and all, I think that we should just intensify the efforts in terms of having more of gas-powered trucks. I think encourage the same way we've pushed the CNG conversations for cars. It should also be pushed for companies that run a lot of these trucks. Like, okay, take this as an incentive to use this. That's one. Number two also has to do with infrastructure. I think we need to, if we're able to fix our roads, the demand, the imbalanced demand would actually reduce over time. So it is a mixture of infrastructure issues and deliberate attempts to actually move away from move away from fossil fuel diesel. And for companies that still use diesel markets areas and all, I think just give them power. Just give them power, and the demand suddenly will just decline.
Okay, Daniel said that you should just give them power. And while rising diesel costs tighten pressure on business nationwide, another concern is emerging on the fiscal side, this time over the delayed submission of the medium-term expenditure framework, a key document that determines how Nigeria plans and spends over the next 3 years. Nigeria's fiscal credibility is under scrutiny as the Center for the Promotion of Private Enterprise, CPPE, warns that the delayed submission of the 2026 to 2028 MTEF violates the Fiscal Responsibility Act, which requires transmission 4 months before the new fiscal year. CPPE says the late submission risks weakening legislative scrutiny and compressing analysis time, undermining a 34.33 trillion naira revenue plan and the macro assumptions tied to the framework. The think tank welcomed the revised assumptions, oil benchmark $64 per barrel, exchange rate at 1,512 naira per dollar, and budgeted production at 1.8 mbpd, but insists the reforms do not go far enough. It flagged gaps in crude outputs, projection, pricing assumptions, and the risks that overestimation could distort the federal government's medium-term fiscal planning, especially as we're heading into the 2027 election cycle. Now, that brings me to the question, Daniel. Does the delayed MTEF submission weaken Nigeria's fiscal credibility?
Well, I don't think we have a kind of credibility in the first place, but let's assume that we have. There's a reason why laws are set, so that we can follow through with the laws, right? Because why I said that was that up until this year, we were still running last year's budget into this year. In fact, we've not even implemented some of last year's budget. So there's a bit of, I think it's one of the worst we've seen in recent times. Yes, we've seen a lot in terms of fiscal discrepancies here and there, but I think this is worse. We've not even had a report of performance of last year's budget yet. It's only the only budget agency that has been close to reporting is the Debt Management Office. Ministry of Finance has not really given us details of how we've been spending, and now there's another medium-term framework coming up, and the law says 4 months, right? So we don't have that yet, because then I don't blame them for not having, because up until September we're still looking to even to implement 2024's budget. So the scattered approach is not allowing this happen, and the way it has always been, we were in these countries where a certain year's budget will be passed in the same year. In fact, sometimes passed in April. I remember Buhari's government went as far as passing the year's budget in April. So this is almost looking like it, because the whole idea, as soon as the law was passed, I think the first 2 years, the Minister of Finance then would come through with it, release, would do that. It helps, because how do you plan when you don't have when you've not properly strategize? How do you implement these things when the time it allows you to even go through the Senate and the House of Reps to basically evaluate these things? Now what happens is now you're just pushing across to them, and because of timing they will rush on it, and Nigerians will start seeing figures that are funny. You get maybe a month later it will start coming out that why are we spending on this? The real idea is that every part of the government should work efficiently, and I think the executive should do its part in simply doing what the law that it's approved that should be passed should do.
So let's look at the assumptions, right? The assumption of 1.8 Mbpd production, which is $64 per oil price. So now, realistically, right? Do you think that we are going to get there to enough that we are going to be able to avoid mid-year budget revisions?
Mid-year budget revisions is always a thing in Nigeria. In fact, I think whenever you don't do it, it's as if you don't know what you're doing. So I think it's more like a culture here. No matter what happens, and this is the reason why. This is what we do. We would have a budget of, let's say, 50 trillion or 51 trillion, and we would usually overshoot the revenues because so that we can play down the budget deficit, right? Meanwhile, the real conversation is that if you see a budget of 51 trillion, more than half of it is usually borrowings, right? So what happens is that when the revenues now see a shortfall, right, you now see us trying to review so that we can get access to more loans, right, or do more borrowings, whether it's local or foreign, to now balance up the figures. So that's always been the issue, right? We still do supplementary budgets in this country, even though a lot of components of the original budget is usually tied to a lot of waste, right? You still see spendings on computers, spending on cars every year, and you're wondering, is that how frequent we need to change these things? So our budgetary conversations, it requires a lot of oversight, right? But because times like this is where it is usually rushed, right? So because it is usually rushed, it doesn't give the Senate get proper time. For example, now, even if you present a budget now to them, they probably will not review until next year because they are going on break very soon, right? So, and when they come into the new year, it's just about passing it. So it is more like it becomes rubber stamp when there is no proper evaluation, proper scrutiny of your fiscal component. So
do you think that our revenue framework structurally is achievable without widening deficits or relying on optimistic oil projections? Especially with Nigeria projecting
we would definitely rely on oil production because that is one of our major sources of revenue. Yes, we now have a reformed tax system, but it's the first year. We cannot judge or completely confirm how effective it will be yet, right? What we're just doing is just still making speculations. Yes, there will be a high level of collection, which would improve based on previous years. So based on what we've seen this year, trajectory of 20-25 million trillion, we should be expecting maybe about around 30 or thereabouts. If we are able to do our own part of oil production, yes, we should be able to say, give or take, our numbers should increase based on what we did this year. However, all what we say, all what we are going to be saying this year is still what we heard, not necessarily what we see in paper, what the report coming out. So the trust in being able to deliver all these things is not at the 100 because the trend of quality reporting, accountability is not there. Yeah. So, but if we do our part with oil production, do our part with effective collection in terms of taxes, yes, we should get a good number and reduce the deficit as much as possible.
All right. And staying with the broader push for financial sector reforms, another long-standing banking practice is now back in focus. One many Nigerians know too well, the referee requirement for opening current accounts. Nigeria's decades-old referee system for opening current accounts is coming under renewed scrutiny as digital identity tools now outperform the analog method, with the BVN linking over 60 million bank customers, NIN registering more than 104 million Nigerians, and SIM and NIMC, NIMC integration, creating a unified verification ecosystem. Experts are now arguing that handwritten references provide zero measurable risk protection compared to the digital checks. Many digital banks already onboard customers without referees relying on behavioral analytics and real-time monitoring instead. Now, this outdated requirement continues to slow onboarding for diaspora Nigerians, foreign investors, Nigerians, pension contributors, and corporates, despite the fact that over 95% of new current account applicants already possess regulated savings or corporate accounts with traceable histories. Stakeholders now insist that eliminating the referee rule would reduce friction and also improve financial inclusion, help us align Nigeria with global markets such as the UK, US, South Africa, many other countries where digital KYC is not acquaintances, signatures drives compliance. Now that takes me to the question with BVN, because we know BVN and the whole NIN thing and open banking already providing high fidelity identity verification. What is the real regulatory value if left, like if there's any, right, left in the referee requirement today?
And so I think more often than not, I think we've gotten used to, because for example, I've not seen a particular issue happens and they said it is the referees that would, because the idea of having the referees to kind of stand stand for that person if there's an issue pertaining to that particular account, and I've not seen any issue that the bank has gone after the referee. So it was always just an extra, just more like a routine conversation. I've not even seen a conversation whereby the banks even do proper check on whether this person is can be a referee or not. We just bring two people and give us their details, and so that is why I support what the analysts are saying, because the whole idea of having two referees is for proper compliance, for proper regulatory compliance, so that you can be able to confirm that this particular individual or business that's opening the current account is able, right, to hold an account, is legal, is so those guarantee conversations and have now been replaced by almost like you said, NIN, the BVN. So that's the essence it has lost its value. So it's only normal that it should be scrapped. We don't have open banking. We don't have so many, because with open banking you really don't need anything. You can practically should be able to open an account in minutes, right?
Yes.
So I believe that the CBN is looking at.
So do you think that they should actually abolish this referee?
Yes, it should be abolished, because except we just want to keep doing a routine conversations. For example, I have a pending account I'm trying to open, and they are saying it has to be from the same bank, and I've only seen one person, so I'm practically looking for people. So even someone I don't know particularly,
once the person can actually
exactly. So it defeats the purpose and the whole idea of and I think the world has left that like almost 2 decades ago. The way banking is now, I think that it's not necessary to still have a refereeing system in
now
place.
Let's look at how much onboarding efficiency and capital inflows could Nigeria gain if banks fully transition to digital only KYC.
You see, you would never know how much it is unless you do a survey of what the fintechs, what the digital banks have been able to make or collect from this market, right? We would think that the market was small until the fintechs came in, and you can see each of all those fintech banks, I don't want to mention their names, the number of customers they now have, both,
and many people use
both
their
corporate
services.
accounts, because the idea of current accounts in the first place was just for corporate organizations and for personal use, where we call it checking accounts. People in the US call it checking accounts, where you can issue checks, just obligations and all. But we've gone past that. How many people still issue checks nowadays? So everybody can even do a standing order now and just push an order on your bank app, and it pays a certain amount on a certain date. So the whole idea is that the banking conversation has moved to digital, right, into now that the traditional banks need to also move along with it, or else what they've done is what will keep happening. What they've done is that they've lost a lot of customers to the digital banks, even though they now feel they are not as regulated, but they are doing their regulatory compliance very well. And in fact, they are doing it way better, because now they can even track your location. So you can actually use your bank app to track your location, because they are doing
and some of them, before they even get to, I think they do it in stages. Before you get to a certain stage, they have to visit your location.
Exactly. So when you see that digitally you can actually do more security, right, than the old offline still signing papers, because a lot of them still give you real papers to fill. While you can just give me a link, let me fill up the details, stamp my picture and everything. So those are the things that has to change again, because it is two ways. Assuming there are no digital banks doing this already, you would say yes, they are the only ones, so they have to adjust. If they don't adjust, people move to the digital banks and take advantage of the solutions that they are offering. And that is what will happen to diaspora. Everybody that wants to set up something like that, you just use these digital banks and wait for them, the national banks, to also follow suit.
Okay. You heard Daniel, we should all grow with the flow, right? Do not be left behind. And staying with the market activities that shaped the first week of December, let's turn to the equities market, where investors finally caught a breath after weeks of heavy sell-offs. But before then, let's take a quick break, and we'll come back. We'll look at more stories as well as the market trends. Stay with us. Welcome back. My name is Divine Alex, and you are on the Business Lens on Rapid TV Abuja. Now, diving straight into it, where the Nigerian stock market rebounded strongly in the first week of December, reclaiming 2.436 trillion naira after the record of 6.5 trillion naira loss in November. The recovery was driven by a massive 996.84 billion naira single-day gain on Friday, pushing market capitalization from 92.725 trillion naira to 93.722 trillion naira, while the all-share index rose 1.07% to 147,040.08 points. Week on week, total value increased 2.7%, supported by improving investor sentiment and bargain hunting across key blue chip counters. Now, activities also surged to 6.617 billion shares worth of 113.224 billion naira traded across 109,590 deals, with the ICT sector denominating at 3.5 billion shares, which largely boosted by transaction sector performance was broadly positive, except for the oil and gas index and commodity index, while market breadth improved to 55 gainers versus 29 losers. Top gainers included UACN, Transcohort, while some led the laggards. Now, the question is, with the market recovering 2.4 trillion naira in 1 week, do you see this as a sustained reversal?
I wouldn't say it's a reversal. I would say the initial November downturn was more like a retracement, and this is just going back, because when you look at the all-share index, I think it's up 41% year to date. So it has still been a quality year in terms of profitability for investors. However, I think that this quick resurgence, because this is almost 50% of what was lost in November in just a week in December. I think it also has to do with some sort of confidence we're getting from the capital gains conversation. I think there's been a relaxed approach in terms of we are sticking with 2026. I think what was coming out from the reform ed was that there's likelihood there's going to be maybe if you invest your proceeds from the market, you will likely get a tax waiver. So I think that is what would eventually happen. Most of the funds that have left will most likely come back, and they will push. In fact, I'm predicting that most likely by the end of the month, we should be having all-share index close to 150,000 points. And there's a likelihood also that we might even do more numbers than last year. Based on that. What is even interesting is that the move is not being driven by the usual guys. The last year, the usual drivers was the oil and gas sector, but now I think we're seeing more of consumer goods. We're seeing ICT. We're seeing services-based conversation, and I think that is good because even though it can be of two different issues, one might be because their share prices are low and investors are looking for where to pump prices and just take profits, or it can be that there's actual belief that the stability we are seeing in the real sector will play into those businesses doing well in the new year. So people are investing in those stocks now. Okay,
so the ICT sector, right, accounted for 52.89% of the total volume. How much of this is real investor confidence versus speculative trading?
Yeah, so I think the ICT sector is still fresh in terms of its contribution to the market, and I think that people are basically seeing that there is a potential opportunities for ICT businesses, for fintechs going into the new year. So as an investor, what am I looking? I'm simply looking for either I'm looking for a growth stock or a value stock, right? If I'm looking for a growth stock, I'll look for stocks that are cheap and I can invest in quickly, and they can give me 50%, 70%, 100% return in a short time. Or value stock where I know that I can just, which is what the banks usually stand for. The banks will not give you too much profit now, but they will give you stability, and that is where more investors are investing. You see more numbers, volume. That's where the volume comes in. Goes to those stocks that would give higher returns in a very short or medium term. But then you see them invest more. You see more actual naira value volume on those bigger financial institutions, insurance and all. Okay, so with the YTD performance at 42.86%, what macro risks could still threaten equities and the final weeks of the year? I think for the final weeks of the year, I don't, as it stands, what would drive the end of the year will be purely sentimental. I don't think there is any major macroeconomic issue that can push. But into the new year, yes, if the government doesn't, in fact, if the government doesn't keep the stability it has been maintaining, there might be a problem. But as it stands, I think that government has done its best in terms of what is stability in 2025 to guarantee that going into the final weeks of the year, the market will still maintain its positive performance. Okay, so now away from that one, let's dive deeper into the market. Now, this month, today being December 8th, 2024, the Nigerian equities market sustained its December rebound today, like I said, adding 412.5 billion naira in fresh market value as renewed bargain hunting pushed the all-share index up by 0.44% to close at 147,689.52 points. Market capitalization rose from 93.72 trillion naira to 94.13 trillion naira, driven by strong demand in banking, industrial goods, and ICT heavy counters. Turnover improved slightly with 412.8 million shares traded in 23,104 deals, even though total trade value declined to 11.92 billion naira, signaling cautious accumulation ahead of key CPI and FX data expected this week. Also, banking measures extended last week's momentum as Zenith Bank, GT Co, Access Corp, and UBA jointly contributed over 41% of total market turnover. Zenith led activity with 62.1 million units traded, boosting the NGX banking index by 1.12%, while GT Co soared to a new 52-week high at 79.40 naira, up 3.1%. Now, top gainers were Transcorp, USCN, and Fidelity, while sell pressure weighed on FTN Cocoa and Mansard, keeping market breadth at a positive 31 gainers versus 18 losers. Meanwhile, the ICT and financial services sectors once again dominated the day's transactions, jointly accounting for 72% of total volume and 58% of total market value. E-Transacts, Access Corp, and Cornerstone Insurance collectively recorded 198.4 million shares traded, cementing their position as the most actively traded stocks of the month. Sector performance was broadly positive. Industrial goods index at 0.67%, consumer goods index at 0.41%, while the oil and gas index fell 0.85%, dragged down by mid-tier energy counters reacting to rising diesel prices and fresh concerns around supply constraints. Now, that brings me to the question, Daniel. What does this, market situation say about our economy, especially ahead of 2026? Okay, so I think that what it's saying is that there are going to be opportunities going into the new year. I, for one, believe that I think insurance is showing some level of resurgence. I think the Insurance Act that was passed this year is giving a bit of life to the insurance sector, also insurance subsector. It's going to be a nice time, because then I'd want to see how how the usual players, the banking stocks, because what they are mostly for is they drive a lot of turnover. They are liquid.
Mm-hmm.
People can buy it, exchange hands, and very fast. So insurance, the fast moving consumer goods, in some of the industrial goods that did well this year. I would be looking forward to seeing what they will be doing going into the new year. Even, no matter data that comes out from CPI, it will still be a very good end to the year, and we basically wait for what next year
is going to give us. Okay, thank you so much, Daniel, for being a part of the show today. And that is how we are going to wrap up today's Business Lens. Join us again on Thursday, 11 a.m. for another interesting take as we track the markets, the money, and the moves shaping Nigeria's economy. I am Divine Alex. Thanks for watching, and don't forget to stay with Rapid TV. Bye for now.